everyone, welcome back to Money Monday. Now this is just a quick video I've made for you because I wanted to talk about the stock market both globally and within Australia. Now at the moment the share markets around the world are all pretty jittery, very volatile, and if you watch the news or read the papers, everything is doom and gloom. Everyone's talking about recessions, collapses, crises, is there another GFC coming? And it's funny, I actually look at this and think, wow, there is so much amazing potential out there to build incredible financial wealth from a long-term perspective. And I get excited when I see this. Now, to explain the reason why I'm so excited, I want to give you the analogy of Boxing Day sales. Say we go to the shopping centre and we each have $300 to spend, and we go on, say, Christmas Eve. And we discover that we can only buy 3 pairs of jeans for $300 each. But if we decide to hold out and go to the Boxing Day sales, we know that we can most likely buy more than 3 pairs of jeans. We might be able to buy 3 pairs of jeans and 3 t-shirts. So we're gonna get more bang for our buck. We'll come home with more clothes. Now, who doesn't like the sound of that? So the stock market during times of economic crises, or the media being very loud and domineering with a negative voice, can often present amazing opportunities to get more value for money. So say, for example, you're doing the $1,000 project and you've got $1,000 to invest, and a share price comes off, say it drops from being $20 to say $18. That means with your $1,000 that you've got to invest, you're going to be buying more units with that $1,000 than you would if the share price was, say, at $20. You're probably saying, but Canna, what happens if I already bought $1,000 worth of stock at that stock at $20? Well, then that's absolutely fine. You keep holding that stock, or if you wanted to, if you were really aggressive, you could potentially buy more stock at $18 and lower your average entry price. However, you don't necessarily need to do that, and that is obviously a very aggressive strategy. You've got to remember that when you're buying shares, you're investing for the long run. And when I say long run, you've got to remember you're a business owner. You own part of that business, and the investment you're going to hold for at least 10 years. Now, with my own personal portfolio, when I buy stocks in a company, I intend in holding them indefinitely. And the reason why is I love my dividends, because my dividends, I'm building them up over the long run, and they're eventually going to pay for my very early and comfortable retirement, assuming all goes to plan. It doesn't really actually matter what the share price is currently trading once you've bought stocks. It really doesn't matter, because you're not actually selling the stock, you're actually holding it for the long run. And in the meantime, you are receiving dividends from those stocks, which is your passive income. Okay, so here's another analogy for you with market movements. Say you buy an investment property for $500,000 and it is rented out at $500 per week, which works out to be a 5% rental yield. Say the property next door to yours, which is absolutely identical, same layout, same number of bedrooms, bathrooms, identical, and is also rented out for, say, $500 per week. Now, the property market supposedly crashes, and that property is now only worth, say, $400,000. Now, and say it sells. Now, say I come knocking on your door and say to you, well, I'm going to buy your investment property from you for $400,000 because that sold for $400,000. You'd say, hang on a second, why do I want to sell? I'm going to crystallize a $100,000 loss, which would be detrimental to my financial wealth and my long-term financial goals and journey. And also, I'm still receiving $500 a week in rent, so I'm not really worried that the value of the property is down. It still serves its purpose for me. It's still paying me a passive income, and that passive income hasn't really changed. So you tell me, rightly so, to bugger off. Now, it's exactly the same principle with shares. As long as you're receiving your passive income, the dividends are coming in, and they're healthy dividends, there is no need for you to freak out during a market correction. If anything, it presents an amazing opportunity to buy more, add more shares to your portfolio and buy more long-term passive income streams. Now, this is a strategy that I teach and show my SaaS financial clients, and one that I implement myself. I'm not recommending everyone rush out and buy shares because everybody has a different attitude and appetite towards risk. And your portfolio doesn't have to be all shares. There are so many other different investments out there available to you to invest in. So it's about having the right balance. And I promise you I will do a video on this, what we call asset allocation. But I just want you to be aware of the media, and when you see all this doom and gloom, in the newspaper and in the news, and people talking about stocks crashing and so forth, remember, ask them what's happened to the dividend. What is the dividend yield? Now that's it for this video. It was just a short one, just giving you a sense of perspective and some grounding for when you hear, see the herd mentality of people letting emotions guide their investment decisions backed off from the media. I hope this video has been of help. I will see you next week on Money Monday. Ciao!